This is TreppWire Week in Review for the week ending July 26, 2024. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, we saw disappointing new and existing home sales as high mortgage rates continue to stifle single-family house demand. The Services Purchasing Managers Index came in at a 28-month high, indicating strong growth in the service side of the economy, but the manufacturing PMI fell into negative territory. There was little change in employment levels, and most anecdotal commentary from businesses has highlighted their worries about political uncertainty and potential swings in regulatory and monetary policy come next year. Stephen, in the broad sense and in the CRE market as a whole, have we stuck the soft landing yet?
One side of me wants to say, sure. All the data we've gotten is clearly indicating that we're right on that nice glide path for a soft landing. But for anybody who's been following markets this week, and in particular the sell-off we've had the last 2 days and some of the earnings headlines, I think there's probably a little bit of trepidation, a little bit of anxiety that's starting to creep into the market to say, yes, it looks like that, but could we see something spiral out of control? And what was interesting today that really threw a wrench in the perception of that negativity is we got US GDP numbers that show the US economy grew at a 2.8% pace in the second quarter, way more than was expected. So economists that had been surveyed were forecasting a 2.1% growth rate. And this is coming off of the first quarter growth rate of 1.4%. So, I mean, we hit almost 3% here on GDP, which is just wild. But if I look at the market's reaction today here, in particular, let's focus on the bond market, yields have dropped. We had a little bit of a steady march up, at least on the longer end of the yield curve. We got somewhat of a bull steepener with the yield on longer dated securities or treasury bonds pushing up a little bit, and the 2-year had held a little bit stable. And so anyway, the inversion we've gotten between the 2s and 10s is now less negative than it was, which is dialing back some of the recessionary concerns. But I would say we don't want to probably interpret this as, oh, it's less likely that we'll have a severe recession, because part of this has to do with fiscal concerns about unsustainable federal deficits. So some have called this Trump trade. I think it's probably more fair to call this just the fiscal concern trade, where we're kind of acknowledging that both sides of the aisle have zero appetite to address the fiscal issues that are present in our economy. So really, if you step outside of that GDP print and look at some of the other data we've gotten this week, there's some data points that would maybe indicate that it wouldn't be the worst thing for the Fed to cut in July, even though that might be somewhat of a shock and taken as a negative signal. But honestly, Lonnie, is there really any difference between cutting in July and September?
No, I think you're going to see a lot of pressure being put on them to make some decision in July now, because I think, kind of use your glide path and soft landing analogy. Just because the plane lands doesn't mean it stops safely. And I think that's kind of where we're at here, where you might have a soft landing that doesn't end as well as you like if you can't stop the plane. And that's where it feels like we're just on this slippery slope where unemployment is going one direction. GDP now comes in way hotter than what we expected. Nobody really knows what to expect. The mounting pressure on CRE and everything else has been persistent. That's not changing. In fact, this week we saw Blackstone REIT, their mortgage REIT, cut dividends significantly. They cut their dividend 24%, mostly fueled by increased interest rates. Borrowers struggle to make payments and refinance their loans. This is on the heels of KKR, Real Estate Finance Trust, and Ares Commercial Real Estate cutting their dividends 42% and 24% respectively. So if you look at this in totality, the Fed signaling maybe they're ready to pivot, I think gives a little bit of boost to just the morale and sentiment around the market. And as you mentioned on the last week's podcast episode on just the staggering number of vehicle, delinquencies and repossessions and everything that's tied to that, you look at credit cards, it tells about the same picture. I think moving a rate cut up would be a nice jolt for the market because the data is too conflicting at this point. Look, if you take an objective look at this, you have to give Powell credit. Like he said they're going to be higher for longer. He said they're going to be after the transitory, debacle. They've been committed to this, that they were going to stay committed to it until they saw inflation numbers and they saw movement in the market that they thought showed inflation had been adequately addressed. Unprecedented moves in the rates, you would have assumed everything would have fallen apart, that it just would have been a disaster. And in reality, like it's actually played out kind of textbook if you look at it. But I think this is where it gets really precarious, because you're getting those mixed signals where now it's not just pure data driven. Like the data tells you that the market's still too hot on the GDP side, but you're also seeing unemployment rise at a pace that you haven't seen in a very long time. That nuance is where it comes into play. And I think it'll be interesting to see how Powell reacts to this. If he continues to toe the line and takes the hard stance, or if you see a little bit more aggressive move towards, kind of pivoting with the rate cuts earlier than what was expected. But again, even if they cut rates in July, Stephen, at the beginning of the year, where people were pricing in 6 rate cuts. So if you get one in July and one in September, all things considered, you would say that he still had a pretty hawkish year relative to what the sentiment was in December.
Yeah, I'm fairly confident at this point that the Fed is going to be very, very in tune with the downside risks that are accumulating around them and not be overly dependent on backward-looking data. I think Chair Powell is very proactive in the conversations he has and trying to get an all-encompassing view. Say this another way, it's not like he's locking himself away in an ivory tower and leaning on some antiquated, in today's environment, you could say probably busted quantitative models, try and steer this economic plane down smoothly as possible, even though there's going to be some turbulence. And I think turning back to the Blackstone news you mentioned earlier about how they cut their dividend, that's an interesting one to dig into. And I think we'll see some recurring themes here in the podcast. So I just want to dive into some of the metrics here from their earnings. So they had to cut their dividends by 24% due to an increase in defaults and continued borrower struggles to make payments or refinance their loans. So let's start with the refinancing metrics that they tossed out in their earnings. 91% of the $5.1 billion of performing loans that reached their maturity in the first half of the year were able to successfully repay, or they satisfied the extension tests and were able to extend that loan. At the opposite end, roughly 9% of loans did not successfully refinance and had to be impaired. And so to dig into the 91% a little bit more, 58% of maturities in the first half were repaid or satisfied an extension test. Another 33 were able to extend with additional equity commitments. And what's driving some of this stress is the office portfolio. And so they have I think is a fairly transparent disclosure on their office portfolio. So office makes up globally for them about 36% of their loan portfolio. 26% of the portfolio is U.S. office, 10% is non-U.S. office. And if we look at the breakdown of their risk ratings, so they rate loans on a scale of 1 to 5, 1 being the safest, 5 being effectively impaired. And so about 55% of their office portfolio is rated 1 through 3. The other 45% is rated in categories 4 or 5. So let's focus on that category 5. They have $1.5 billion in office loans that account for 7% of their overall portfolio. So that's not just the office segment, it's 7% of their overall portfolio. And they have a 29% CECL reserve in place. So almost 30 cents on the dollar is being reserved for future losses over the lifetime of these loans, which implies a 53% value decline since origination. And 85% of loans in that category 5 buckets are pre-2015 vintage loans. Office just continues to be the pain point. And while we might be finding some bottom in valuations, those value declines are significant. And it's really taking the trigger events of tenants blowing out and cash flow turning negative, or the loan hitting its maturity date to actually trigger that stress. And so surface level, cutting your dividend is something you really want to try and avoid if at all possible. But conversely, they did repurchase 150 million in shares to try and blunt that dividend news.
Yeah, and I think none of this is news to the market. I mean, like it's being reported now. You're seeing them take the action on the dividend cut. but all the underlying drivers that you just mentioned, the appraisal reductions, et cetera, like we've been talking about this, the market's been talking about this, they knew this was taking place. This isn't going to be the end of it. Like we're going to see a lot of different, whether it be REITs or just owner operators effectively dealing with the brunt of those value declines in real time. We did a Market Pulse webinar today, Stephen. So some of our podcast listeners maybe were on that Market Pulse webinar, but you did a really great job of just talking about in the banking sector. I know we're going to have a little bit of discussion on this later today, but how the office challenges that are maybe impacting Blackstone and some others, and the banks in particular, is not enough concentration to bring the market down. So I don't want to belabor that now, but we did mention last week, we were going to talk a little bit about the AAA bond risks and that we had the one property in 2024 that the losses actually got all the way up to the AAA, and the Wall Street Journal wrote an article about, SASB bonds that are backed by delinquent loans were cited in there, and it goes through and lists a bunch of properties. And you had done some research on this, not just for this particular piece, Stephen, but also just looking at the differences in vintage of like how frequent AAA investors were impacted during the GFC compared to what we just saw this year. Maybe just give us a little bit of color and walk us through what that analysis looks like.
Sure. So as Lonnie said, if you're interested in seeing this data, please reach out. We'll send you a copy of the slide because visually it really pops out beautifully when you're looking at the losses by vintage and rating bucket. So what we put together was an analysis of effectively for each vintage, how high did losses climb in the bond waterfall, in the capital stack. So we started at 1999. And what you see is cumulative losses really kind of tapped out right about the BB bond range. But as we get into the 2002, 3, and then certainly the 06, 07, 08 vintages, what you see is this steady pattern of the percentage of higher rated bonds is increasing in terms of the percent that took a loss. And this is done on a count basis. So dollars are not skewing these stats here. This is simply for each deal in these vintages, how high did losses climb up in that one deal through the ratings. So if they ate up to the BBB, well, that'd be one observation in the BBB bucket. And we're looking at this as a percentage of the vintage. And so when we get up to 2007, 36% of deals in the 2007 vintage, 36% had losses eat up to the AAA level. Now, mind you, back in 06, 07, the AAA rating was assigned to bonds with credit enhancement as low as 10 to 13%. Those were the junior AAA tranches. In today's environment, those would be rated, generally speaking, around AA or maybe even single A, depending on the deal. And so it's a very different dynamic today. So when we get into the newer vintages, certainly, say post risk retention, but let's start with 2011 forward. By and large, cumulative losses have only eaten up to the non-rated, the first loss tranche. So in other words, these deals are kind of performing as you would hope, that the first loss tranche is absorbing the first loss. And while you do see some sporadic activity, most of it tends to still be concentrated in the tranches that were originally rated non-investment grade, so BB plus or below. So that one 2015 SASB deal that took a loss, that got a lot of headlines, and in fairness, rightly so. I would just caution to say it's not like that's a tidal wave of losses coming for AAA bonds again. There certainly are likely to be more originally rated AAA bonds, particularly within SASB, that are likely to get clipped based on where we've seen valuations go today. And part of this, I think I should also highlight, is it's very important to highlight that cumulative principal and interest advances are part of this equation. Because if a bank has a loan where the borrower stops paying, it's not like the bank says, well, we're going to take money from our right hand and hand it to our left hand and keep paying ourselves interest. And then when this loan liquidates, we're just going to recognize that interest expense, and it's going to push up the loss severity. That's what happens within CMBS because, well, that's just how the market functions, right? If you shut off interest up to the AAA level, implicitly that bond would no longer be AAA. And so servicers will continue to advance interest on the balance that they think is recoverable. Whereas that's not the case for, say, bank and life co loans, which makes for a pretty dramatic discrepancy, or I should say difference between the loss severities you see in CMBS versus banks and life cos.
Yeah, that was a very thorough walkthrough, Stephen. And as you mentioned, the slide, I think, just paints a different picture. I mean, the visual representation, I think in the market pulse, you said, look at the diagonal line during the GFC, and it really highlights the challenges. And at least to date, what we've seen so far with the 2015 vintage deal is kind of a one-off. We wouldn't be surprised to see some additional distress that reaches that level, but we don't think we're going to be anywhere near what we've seen in the GFC. It's an interesting topic. It's another one of those things, though, where you look at the headlines and you think, oh my goodness, maybe the sky is falling. But when you start digging through the data at a granular level, it doesn't match the narrative at some level, and hopefully that remains that way, where the market is resilient and you don't see those types of losses broad brush.
So let's talk about banks. We've seen a lot of headlines this week about commercial real estate exposure, the size of banks, and whether or not they feel like their loans are safe or not. Let's talk about some of the data that we've looked at and what these headlines mean.
Yeah, so Haley, I mean, this is the topic du jour, it seems like, is, how safe or secure is the banking system and what does this mean for banks? And so Deutsche Bank warns of a hit from commercial real estate exposure. That was the headline in the Wall Street Journal. They increased their guidance for full year credit losses. They expect to see continued pressure based on their CRE portfolio at a time boost from high interest rates begin to unwind. They anticipate office credit portfolio to remain under extreme pressure in the second half, even though there's been some signs of stabilization in the overall CRE sector. Deutsche Bank's multi-year turnaround effort got a boost in recent quarters from higher interest rates, but that tailwind's losing steam as the central banks move to cut rates, while commercial real estate sector remains under stress. So I think, if you take the 2 or 3 main bullet points from this article, it paints the same narrative that we've talked about for some time. Like, yeah, there's a benefit potentially with the higher rates on one side of the ledger, but you have these non-performing properties and the challenges that we've talked about ad nauseum on the other side of the ledger. And now you're starting to see, some of the central banks reduce interest rates. We just talked through on today's episode. We think we might see an acceleration of rate cuts here in the U.S. So these banks are really struggling with how to balance that. And the real estate sector just doesn't move as fast as the news and potentially the impact of the rates themselves. And so, Stephen, I know you did a really deep dive analysis of, kind of spurred by this article and some of the other topics that have been discussed over the last couple of months related to banks broadly. You did a deep dive through a large number of bank reports, and you're going to give us some really granular deep dive information on this.
Yes. So we've been asked a number of times if we can speak to the office exposure to the banking sector as a whole, because we do have the Trepp anonymized loan level data set or taller data set that covers a collection of or a consortium of banks that contribute loan level data quarterly to us that gets anonymized. And so from that sample of data from the broader banking industry, we can speak to the precise exact amount of office exposure banks hold. But that's only a sample. So I said, well, let's broaden this sample even more. So what I did was I combed through the financials for the 100 largest bank holding companies by the amount of commercial real estate debt they hold. So the amount of the size of their commercial real estate loan book. And of those, I found, 40 of them had reported second quarter financials and disclosed the office exposure. So a good number of banks that have reported second quarter financials. When I dug through the investor presentation deck, I could not find, at least quickly or easily, any details regarding the specific amount of office exposure. But for 40 banks out of the 100, I did. I also pulled an additional 4 banks that were smaller in size to make sure I could round out the population of the sample of banks with less than $12 billion in CRE portfolio size. So I got a very, very comprehensive snapshot of exactly how much office exposure is on the balance sheet of these banks. And to tie it back to the Deutsche Bank story, Deutsche Bank was far and away the heaviest in office of any bank I looked at. I mean, it was multiples higher. So specifically, what they reported in that investor presentation deck showed that 42% of their CRE portfolio is in office globally. If you look at only the US portfolio, it's 45%. That is massive, absolutely massive. Because to break this down by bank size, if we look at the banks that have a CRE portfolio of $30 billion or greater, the average office exposure as a percentage of the CRE portfolio is 19%. Once you get to below $30 billion, it's very consistent at right about 15% of their portfolio is office. And it obviously ranges between 10 and 20%, generally speaking, but very rarely do you see banks go above 20% in their allocation to office. It does happen. Importantly, a good chunk of that exposure is medical office. So in doing this analysis, I did lump together traditional multi-tenant office with medical office, but made sure to note off to the side, at least for my own benefit, how much of this is medical. And I think one other point I want to highlight here is that the larger banks that have taken the write-downs that we've talked about in Market Pulse, on the podcast, and a number of different settings, these larger banks are the ones that tend to have the urban office exposure. So think about it this way. They have a lot of money they have to put to work and invest in assets. And CBD, urban trophy office, is a good way to do that. You can put a huge chunk of money to work in one slug for that office loan. And historically, that has worked out well. Obviously, we're in a very different environment now. And so what I do like to see is that these larger banks, a number of them will report how much in loss reserves they're holding aside for just the office portfolio. That's not a very common stat to see, but you do see it disclosed by 5 of the top 6 banks that I looked at here. And what they're setting aside is about 10 cents on the dollar for their office portfolio. So this is called the ACL coverage ratio, or the allowance for credit losses relative to the amount of loans they hold. So either in whole or for a specific sector. So 10 cents on the dollar, or a 10% ACL coverage ratio. To put that in perspective, the ACL coverage ratio for their loan book as a whole, or even just for the commercial real estate book as a whole, generally ranges like 1.15% to 1.35%. The broad range is 50 basis points to 1.5%. It goes a little bit wider than that, obviously, but the tightest cluster that I saw was right in that 115 to 135 basis points in ACL coverage ratio. So it's 10 times that for just the office portfolio.
Wowza.
How's that for a data dump?
This is one of those moments where I wish the podcast was on video and we could show the charts and graphs, because walking through that's super data intensive, but it just paints the picture of, what these lenders are trying to hold back for credit losses. And when you look at that relative to historical norms, and as you kind of mentioned, like the wide band of historical and the super dense area, I mean, this is a 10x multiple in some instances of that. It's really, really crazy to see. But to your point, it doesn't really mean that based on their concentration or exposure to office as a relative percentage of their overall portfolios, like this is not enough to bring the entire sector down, right? So we have a couple of slides on this too, Stephen, we should probably make available if people want it. So if you're interested in the AAA loss data and the bank data, we can probably make some slides available. Shoot us an email, we'll send them over. Thanks for going through that as such. I know when he says he went through 75 of the 100 banks manually, like that means he literally was pulling them up, downloading the files, combing through the files, pulling the data out. So,
and for clarity, I sent that note about a day ago. I have an itch that I have to scratch. And I went through the rest of the 25. I'm glad I did, because a number of them reported earnings within the last 24 hours.
So he's done a lot of legwork to give you some perspective on that by going through the actual data, which is what we do at Trepp. We provide actionable, actual data and insights from the marketplace.
Social media is a massive and growing way to communicate with your CRE prospects. But are you really maximizing the tools available to you? Some of the most powerful tools in human history are at your disposal, and most of them are free, so your prospects need to know how good you are. Have you ever asked yourself, what's the return on investment of these platforms or of my time? Or maybe you need to consider the other ROI, the result of inaction. Missing out on these opportunities will cost you massively. Imagine supercharging your business development with a renewed focus on digital tools and social media at an in-person event. At the CREI Summit 2024, you'll get the chance to do just that. Join us at the fabulous Fourth Hotel in the heart of Atlanta on September 11th through 13th. You'll get to rub shoulders with the best in the CRE industry, learn from top-tier experts in social media, and take your business to new heights. Don't miss out on the event of the year. Buy your ticket today at www.creisummit.com, and we'll see you there. So let's turn to our property type segment, and to start in multifamily, we analyzed some multifamily origination trends by property size over time this week.
Yes. So in the rundown big picture section. And so for those of you that might not be familiar with the rundown or haven't read it yet, the big picture section covers a high level topic or theme that we have just run into a news story about, or we've been talking to somebody and decided, collectively, yes, this is a very good high level topic to cover that I think is important for the market to know right now. And so today's covered the small cap phenomenon. So specifically, if we look at properties that are valued at 5 million or less, deal volume in that small cap sector increased 13.3% on a year-over-year basis to $20.2 billion. Now, this is a really interesting trend here, because if we step back from this and think about what's been going on in stock markets for the last 2 weeks or so, when we came out of second quarter, going to third quarter, and remember that we got that cool CPI print and the PCE reinforced the trend, we started seeing a rotation out of mega cap stocks, right? Some of the large cap names that had been the drivers for stock market returns all year, and investors were rotating into smaller cap stocks because the gap in performance between small cap and large cap stocks was at something like a 20-year high. And so it just made sense to rotate out of some of those mega cap names into the smaller caps that might benefit when the Fed starts cutting rates. Now, we could stand here and have a debate about how timely that trade is, or if people are getting ahead of themselves, or if there's even other concerns about the mega cap tech names. But I don't want to digress much here. The point being that it's really interesting that the stock market is doing a small cap rotation, and you're seeing some of this in CRE as well. What those small cap properties can provide you is better diversification for your portfolio. So you might not be able to scale up to a massive deal size by doing a lot of smaller cap deals, but it just seems natural to see this phenomenon at this point.
Yeah, it doesn't seem too surprising to me, but it's when you put it into context and you look at the increase on a year-over-year basis, it's pretty significant. This is what I love about what we get to do, Stephen, is like you can look at the market in all these different perspectives from all these different angles, analyze them from different methods, compare them to the publicly traded, markets, and see correlations in some instances and see significant divergence around others. And it's just really interesting to see how people take advantage of each and every one of those different opportunities. Like everyone has a thesis of what they think is going to help them in the market, given where we are in the cycle. And it's really interesting when you take maybe a deeper dive into some of these and see, what the correlations look like and how people are moving money around or making deals work at different thresholds.
So we had a data point of the day in the rundown as well that looked at origination trends within multifamily to try and reinforce or tease out this trend. So what we looked at specifically was the amount of multifamily debt originated by year, along with the breakdown of property size by number of units. So this is a stacked bar chart where each stacked bar for a given vintage represents a particular unit size bucket. So say 75 to 99 units. And really what jumps off the page when you're looking at this, a few things. First, like we talked about, origination volumes peaked in 2021 massively. And importantly, if you look at the properties with 275 units or more that had loans originated in 2021, it's a huge chunk of that dollar volume. And if we look over the subsequent years, 22, 23, and then year-to-date 24, and year-to-date 24 is where this really jumps off the page, is those larger apartment properties, 275 units and up, are seeing nowhere near the same level of deal volume that they were. And in fact, if we were to try and trace this back to the last time we saw deal volumes that low, we were to try and annualize that 2024 number, you're looking at probably somewhere between 2016 or 2017 volumes is maybe where we're going to end up this year.
A couple of questions on that. Get your thoughts. I think from a multifamily development perspective, like 250 units and above is kind of where you start hitting kind of an optimal economy of scale metric, right? Like maybe that 250 to 300 units is like in most markets is where you make sense. Now, obviously New York and other really densely urban populated areas where the land costs are so high, you might need to go bigger to make it work. But in a traditional like garden, 3-story, 2-story type of facility, 250 units seems to be kind of optimal. So kind of interesting to me that 275 and up was the largest chunk. But if you look at the chart, and if you're not subscribing to the rundown, we actually put these in the rundown. The daily data point of the day is part of the rundown publication. You would have the visual. That 275 and up has been the largest sector throughout the entire study of this, going back to 2014. Do you think that has to do with high cost urban areas where you have these really large properties, or is the number of facilities that have more than 275 units just a disproportionate number of properties? Like, if you're going to develop a property, you're not going to build something that's less than 275 today. You're just going to build something that's 275 or higher. Like, it just seems like, I could imagine when interest rates were low and values were really high, like there was some flight to quality, and you might see these bigger properties having more activity. But to see it going all the way back to 2014, and even as you mentioned in 2024, where it's significantly less than 23, it's still disproportionately the highest volume of origination when you look at the other property size segments.
Yeah, I think a good part of this story is about churn. Across the board, across all sizes, there's obviously a lot less churn today, given what's happened with values and interest rates. Pick what other stressors that might compound this problem. And so within the 275 and up, to me, it looks like basically from this dollar volume, and I'm sure if we put this on a count basis, it would reinforce it. What I'm about to say is a lot of this is probably the new construction that's getting delivered. To your point, Lonnie, you're not building a 10 to 30 unit complex because it's not scale. And that's also in a lot of urban areas, that's not what you need. We need a lot of housing delivered to try and correct this supply demand imbalance. And so I suspect a lot of what you're seeing in the 2024 number is newer construction, because if you look at across the smaller size formats that are more likely to be existing stock, I mean, that compresses down dramatically. So what will be very curious to see is over the second half of the year, there's been a lot of speculation that deal volume can ramp up in this sector as you start seeing some loans change hands either for forced or motivated reasons. Forced because of debt coming due, or pick your narrative, or because of motivated reasons because you've just capitulated. You said, you know what, it's time to rotate into another asset. And even though I'm not going to book the return or even book a loss on this that I don't love, if I'm booking this not as a 1031 exchange, but as just a traditional sale, well, I'm just going to use that loss as a tax write-off.
You know what would be interesting to see on this chart too, Stephen, is if you could overlay number of properties. Because by definition, the higher the number of units, the bigger the loan balance. So
Yes.
in this example, we may be getting a little bit of bias in the sense that, like, this on an issuance, on an origination basis, dollar-wise, obviously is going to be slanted towards the higher numbered properties. But looking at this in terms of total origination by property count might be another interesting way to say, where has the activity actually been? But I agree with you. I think it's still going to be heavily slanted towards these larger properties. So it'll be interesting to see what happens as we finish out 2024. You mentioned maybe a slight pickup or maybe even a more advanced, origination boom in the latter part of this year. I don't know that I think that's going to happen, but there's a lot of people that think there might be some motivation for that. We're going to stick with multifamily, Stephen. We have one credit story this week, and it's one that we've talked about multiple times on this podcast. We've written about it. It's been written about in major publications. Our friend from San Francisco, Park Merced, has seen another significant drop in the appraised value. So for those that don't know, Park Merced apartment complex is a really large property. The appraised value now has been reduced down to 1.39 billion, which is roughly 20% less than the amount that's owed against it. This is a 3 million square foot student housing complex in San Francisco. And when I say really large, it's 3,221 units. It was built in 1944, renovated in 2009. Was originally appraised at 2.11 billion at securitization back in 2019. And as we've documented, this property's been in trouble since 2020, had significant drops in occupancy, which led to an obvious decline in cash flow. Occupancy at Park Merced had plunged to 76% in 2020, which was down significantly from 94% the previous year. If you look at last year, as of September, the property's occupancy had improved to 83%. But DSCR at net cash flow was reported to be 0.47x. So we highlighted this transfer to special servicing back in April due to the low occupancy and near-term maturity of the loan in December. And as you can see, the appraised value has been reduced. And we did get some comment. We had a commenter on Twitter, I believe, talk about us highlighting appraised values and appraisal reductions and saying that's a flawed metric. Stephen and I don't disagree. In fact, we talked on a couple of episodes about how we think looking at appraised value as the only proxy is a limiting way to look at the overall health of a property, the distress of a property. Appraisals by definition are point in time value, as evidenced here. This property saw a 20% reduction. This property saw another reduction down to 1.39 billion. This is not the first time it's been reduced on an appraisal basis. And we've talked about a lot of times where properties have a negative appraised value adjustment, and then 3 months later, the property may see a 10 or 12% increase in appraised value. So we agree with the comment that appraisals by definition don't tell the whole story. But in this context, it just tells you that this property is upside down, and it doesn't appear, even though the occupancy's improved slightly, to be anywhere near what it needs to be in order for this to be salvageable.
So let's move on to some office stories this week. The first one, we saw a short-term extension for a Midtown Manhattan office loan.
Yes. So this first office story here is the $222,285 Madison Avenue loan that has received a short-term extension through November to buy the borrower more time to refinance and pay off the existing debt. And the story comes to us from The Real Deal. The collateral is a 511,000 square foot office in Midtown Manhattan near Grand Central Terminal. The property is built in 1926 and renovated in 2017. At securitization, the property was worth $610 million. But in 2022, that property was reappraised at $411 million. In 2023, the loan posted a DSCR based on net cash flow of 1.11 times when occupancy is at 97%. In addition to the $235 million CMBS loan, there's also a $35 million B note on the property. This loan was transferred to the special servicer in May of 2022, and the borrower requested a maturity extension. The fixed rate loan had a scheduled maturity of November 2022, and that was pushed out to May 2024. So the loan was transferred to the special servicer again in April prior to the May maturity date due to the borrower claiming that they could not pay off the loan at maturity. And so now they've been granted a short-term extension to buy them more time to refinance that date. More recent servicer notes state that the borrower provided a signed term sheet for refinancing. New debt will mean a higher interest rate, so stay tuned on this loan to see where it actually ends up closing out, because I'm very interested to see what that new loan ends up getting priced at and exactly how much leverage were they able to get.
What's really interesting on this one, Stephen, these terms don't math in my brain. 97% occupancy, 1.11x on the DSCR. So what that tells me is there's some economic loss, right, in the form of either abated rent, free rent, something, or tenants are not paying, because you wouldn't expect a property to be almost at 100% occupancy and only having a nominal cover on debt service above 1.0. I mean, in the office sector, if you're above 1.0x on DSCR, you're probably feeling pretty good relative. But in this instance, at 1.11x, you'd probably expect occupancy to be somewhere in the 80% range, not 97%.
That threw me for a loop as well. And I should mention that this is an interest-only fixed rate loan, and the current interest rate on the loan stated as 3.85%. So if you're 97% occupied and only covering at a 1.11 times at that level rate, so I said I'm very interested to see what this loan gets resized to.
And a lot of our other stories this week covered office loans transferring to special servicing.
So I'll take the first one here in Los Angeles. $400 million Bank of America Plaza loan, which is backed by a 1.4 million square foot of office at 333 South Hope Street, has been transferred to special servicing. Occupancy was 79% as of Q1 2024. This loan scheduled mature in September 2024, was on the special servicer's watch list due to upcoming maturity date. We did write about this back in December when a press release indicated that law firm Shepherd Mullen, which was the third largest tenant, was vacating the space despite their lease ending in late 2024. Earlier in April 23, we also highlighted the loan when the borrower Brookfield DTLA, Downtown LA Fund Office Trust Investor, expressed concerns about its financial viability. This loan is split across 4 2014 deals, all part of CMBX 8.
Next up, we have the $34.2 million Regent Center and Bank Tower loan that also transferred to special servicing at the beginning of July for imminent monetary default. The loan was collateralized by a 492,000 square foot office property located in Shreveport, Louisiana. The asset was built in 1939 and renovated in 2000. Property was last appraised in 2017 at $51 million. Regions Bank is the top tenant with 13.85% of the space, according to servicer data. And that's on a lease that expires at the end of August. There was no updated servicer comments in July as to the status of the Regions space. The loan posted a DSCR based on net cash flow of 1.14 times with occupancy at 80% for the first quarter of 2024. The loan was scheduled to mature in June of 2027 and makes up 7% of a 2017 deal. And this is the first month that the loan has been delinquent, and the delinquency status shows a late payment, but it's less than 30 days delinquent.
And then I'm going to group these next stories just by topic because we have seen appraisal value reductions across office, retail, and lodging with our latest data.
Let's start off here in the Southeastern office portfolio, which is referred to in the system as the Sunbelt portfolio, seen a slash in appraised value. Collateral behind $121.4 million portfolio, 42% slash in appraised value, according to the July data. This loan is backed by 3 office properties, 2 in Birmingham, Alabama, and 1 in Columbia, South Carolina. In total, the portfolio has about 1.3 million square feet. Properties were appraised at $203.3 million back in 2015. We now show a new appraisal value at $118 million, which is slightly below the outstanding loan balance on the property. The loan was sent to special servicing in January of 22 for imminent monetary default at the borrower's request. This was obviously tied to COVID-19 pandemic, according to servicer commentary. Scheduled to mature in July of 2025. Has been marked 30 days delinquent since this June. If you look at previous commentary, it indicates the borrower submitted a short-term payment deferral request at the end of 2023. Fast forward now, all 3 properties are in receivership. Property needs are being evaluated. We've written several times about tenant activity at these properties in the portfolio. We suggested that CMBS investors should keep an eye out on the Sunbelt portfolio note. At the time, we noted that namesake tenant Wells Fargo was planning to relinquish about 100,000 square feet of its footprint at the Wells Fargo property back in 2019. However, it was later announced the internet delivery service Shipt would serve as new anchor tenant at the office tower, and that law firm Burr & Forman had renewed their lease at the property. Those things were not enough to keep them out of distress. Most recently wrote about this loan in February 2023, where we highlighted the law firm Baker Donaldson would be vacating the Wells Fargo Tower at 420 20th Street North, the largest property in the portfolio. The firm was the 3rd largest tenant at the property with about 70,000 square feet, or about 14% of the space in the property. So, Stephen, this is another one of those office deals where you see older buildings having a lot of churn or turnover with the tenant base and just not able to keep up.
Yeah, it's really interesting to see that last move, because what we've seen is that a lot of the leasing activity, and certainly the larger blocks of space, some of the green shoot leasing stories in office have come from law firms. And so to see them making that move just highlights this obviously was at the unfortunate side where I'm guessing they were moving to another property, but keeping their footprint in that metro. So just given what you ran through with the age of some of those properties, it kind of makes sense. So transitioning over to retail for one of our value reduction stories, we saw the value of collateral behind a CMBX 7 mall loan cut yet again. The collateral behind the $186.9 million White Marsh Mall loan has seen about a 15% reduction in its appraised value, according to July remit data. At securitization, the collateral was valued at $300 million. In 2021, the value was lowered to $124 million. In 2022, it was lowered again to $113 million. In 2023, the value is lowered twice to $100 million and then $95 million. And now this month, servicer data shows the appraised value has dropped again to $80 million. So the collateral behind this loan is a little over 700,000 square feet in Baltimore, Maryland. And this is a regional mall. The property was built in 1981 and renovated in 2012. This loan was slated to mature in May of 2021, and it transferred to the special servicer in August of 2020 for imminent monetary default due to a request for COVID-19 pandemic relief. A receiver was appointed in January of 2023. Servicer notes for the past couple of months have stayed the same, indicating that the lender continues to evaluate the collateral, including both leasing and potential loan assumption. In 2023, the loan posted a DSCR based on net cash flow of 1.6 times, with occupancy at 93%.
I think I saw a story this week too about a Baltimore office building being sold at like $14 a square foot. So it's not just the retail sector there that's facing some challenges. There's definitely a large swath of office properties that are struggling too. We're going to transition back to San Francisco for this last story, Stephen. San Francisco hotel loan defaulted. This is collateral behind a $76.8 million Hilton San Francisco financial district. Was lowered off the heels of its transfer to special servicing in October of last year. The loan defaulted at its maturity, which was January of 2024, and is now being hard cash managed, according to commentary. The loan's backed by a 543-key full-service hotel at 750 Kearny Street in San Francisco, built in 1970 and renovated in 2006. If you go back to 2013, when the property was securitized, it was valued at $179.8 million, most recently reappraised for $167 million. If you look at the 12 months ending June 2023, loan posted DSCR at net cash flow of 0.96x when occupancy was at 83%. Our last commentary on this was from March of 2024. Commentary indicated the lender and borrower were in discussions for a 12-month extension. The loan has been marked with the status of performing maturity balloon since March. Updated commentary states the forbearance has closed and that the loan is to remain with a special servicer until payoff. So if you were on the Market Pulse webinar today, Stephen did a really great job of giving you some of the nuanced definitions around performing special service loans and what that means. If you weren't able to attend that, you could shoot us an email at podcast@trepp.com and we can probably send you a video recording of the Market Pulse.
And a few programming notes. This week, we released an in-depth analysis of credit changes. So we know that we publish every month a delinquency rate based on the overall universe, but when large loans move in and out of delinquency or mispayments or cure, that can really alter the overall rate. So in this piece, we wanted to showcase some of those large loan delinquencies, cures, and modifications. So check that out on our website or send us an email to podcast@trepp.com and we will share the findings with you. We also shared a piece about bank CRE loan performance, specifically looking at criticized loans and the trends there. So if you're interested in that piece, you can reach out to us and we will share that with you too. And then turning to shout out, Jason B reached out to us and said he loves listening to us on the podcast. Andrew C said another great podcast for the week of July 15th. Concerning but not surprising that signs are pointing toward a slowdown and maybe a harder landing than expected. And he was interested in our Market Pulse webinar. Mike I is a longtime listener and sent us some information on a receiver. We will have to look into that story that you sent us and see if that's something we can talk about on a future episode. Josh B was interested in our Market Pulse webinar, and our colleague John sent us over a contact. Chris L, who was a podcast fan and was interested in some of our materials related to insurance costs. Craig T was interested in a comp that we spoke about on a recent podcast and was looking in to see if we had the cap rate. We will look into that, Craig, and get back to you. And he also noted he's an avid listener. Mark J on LinkedIn gave us a shout out for our rent control discussion last week. And Gifford W gave us a shout out saying Trepp's podcasts and reports are an excellent source for anyone monitoring the decay in U.S. office loans. We heard from our good friend Shlomo C on Twitter, and he said, Dallas's own Lonnie said, and I quote, I think Houston's one of the only places in the U.S. where you can actually sweat while taking a shower.
Yeah, Shlomo reached out to me and was like, what do you think about this? I was like, well, look, I said it because it's true. Put it out there, man. So he did. And I stand by it. It's so humid there. I mean, like you're in the car, AC on blast, sweating in the shower, sweating. It's just all time, full time sweating. But hey, Houston has some cool culture. It's got some good food. It's got some cool museums, got some good sports teams. Just make sure you bring enough clothes because it's pretty sweaty.
Lenny, I think I can do you one better. We were visiting a friend years back in Houston, and this was during peak summertime. Their AC actually went out at the house, and it was hot. Fortunately, they did have a pool, And I'm pretty sure I was sweating underwater.
I'm not hating on Houston. I love Texas, all parts of Texas, but it's pretty sweaty. Have you ever been to Houston, Haley?
I have never been to Texas, so
Holy
no
smokes.
comments. I know. Sorry, guys. I'll make my way
Yeah,
at some point.
we'll have to figure that out. Did you guys see this week? We didn't talk about it on the intro, but it should have been in there. Southwest Airlines going away from the no assigned seats here in the new year. They're basically, after 50 years,
Wow.
going to have assigned seats. So I don't know. Does that elevate their status on the, on the airline chain?
I don't know. I mean, how are they going to be able to manage that sort of complex logistics on Windows 3.1? I mean, that's what kept them running during the CrowdStrike outage.
Good times.
And finally, Avi S. sent us some of his takes on the national rent control discussion. And he sent us some operating statements and a deep dive here. So I think we might have to get you on the podcast, Avi, to really break this down. So we'll look into what you shared and see if we can get you on an upcoming episode.
Yeah, we'd love to get perspective from someone that actually owns and operates properties in New York that can give a real insider look at what it takes to be an owner with some of these rent control challenges that Stephen and I talked about at a high level. But obviously our understanding is not the same as somebody that's living through that. So Haley, I know we're wrapping up shout outs here, but I just wanted to put it out there. We posted a CRE job last Friday. Got a pretty good response in terms of applicants, but we wanted to toss it out to our podcast listeners and say, if you're interested in joining the Trepp team, we're looking for a commercial real estate subject matter expert. The job's posted. You can find it on LinkedIn. You can find it on our website. It has a pretty nice overview of the job description. But this will be somebody that works closely with me and my team, be integral to our efforts to continue enhancement of the product and get it out to market. So if you have interest and you have a practitioner or CRE background, give us a shout. We'd love to talk to you. We're looking to find somebody that can really move the needle for us here at Trepp.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay well.
All right.